Cisco Systems reported third quarter earnings that beat expectations and their own guidance. Management believes that the $28 billion acquisition of Splunk will have an immediate impact on revenue for the full year ending July. Cisco plans to leverage Splunk's technology to advance its AI driven security and observability solutions, offsetting the continued revenue decline they've been experiencing in the last 4 quarters. Cisco reported revenue of $12.7 billion, lower by 70 basis points quarter over quarter, but down almost 13% year over year. Gross margins, however, were slightly improved to 1.4% quarter over quarter and 2.8% year over year. Operating profit was down 29% on the quarter and 44% year over year to 2.2 billion, giving us an operating margin of 17.3%. The bottom line was almost 1.9 billion, down 28% quarter over quarter and 41% year over year, and that is about 15% of revenue. Looking at our quarterly income statement data from Q3 2022, we can see revenue has been declining since then on a compound basis of 12 basis points. Gross profits have been flat, growing just 21 basis points, but the operating profit has been down by 5.4% and the net income contracting by 5.2%. As we can see on the graph, Q3 2024 revenue is even lower than Q3 2022. Cisco needs a boost, and they hope to do so with the help of Splunk. Turning to our revenue by geography, we can see the Americas is the principal market for Cisco products. However, that market has been declining by 39 basis points, finishing the quarter at nearly 7.4 billion or 58% of total revenue, down from 59.5% in Q3 2022. EMEA is Cisco's best performing geography, having grown by 62 basis points to earn 3.5 billion to 27.2% of total revenue, up from 25.5%. Asia Pacific, Japan, and China have also been experiencing slower growth of 31 basis points. They reported 1.9 billion for the quarter, or about 14.7% of revenue. Turning to the group revenue, we can see here in blue that networking is Cisco's bread and butter. It reported 6.5 billion for Q3. That is about 51.3% of revenue, down from 7.2 billion in 2022, or about 56.1% of revenue. This group has been contracting about 108 basis points. Next in orange is services. This is Cisco's second largest group by revenue, reporting 3.7 billion in Q3 2024, or about 29% of revenue. That's up from 26.4% of revenue, or 3.4 billion in Q3 2022. In red is their security business. It is one of their bright spots among their group revenue, having grown 3.7% since Q3 2022. They finished the quarter at 1.3 billion, or 10.3% of revenue, up from 7.3% in 2022. The collaboration business, however, has been contracting about 1.5%. They finished the quarter at 987 million, or about 7.8% of revenue, down from 8.8%, 1.1 billion in Q3 2022. And lastly, in green, their observability business. That's been growing at 1.6% since 2022, ending the quarter at 211 million. Turning to the ratios, we can see shares outstanding declined by 13 million on a fully diluted basis. Earnings per share were 46 cents, down 28% quarter on quarter and 40.5% year over year. As expected, sales per share declined to $3.10. Cash per share was down quarter over quarter, but up 12% year over year. Book value per share was $11.27, better by 10% year over year. Cisco's PE is 26.02, with the S&P 500 around 27.53. Cisco has a PEG ratio of a negative 64. Turning to our leverage ratios, the debt ratio is 0.16, still a good number, but it's jumped by 147% quarter over quarter due to the Splunk acquisition and the assumption of about 20 billion in debt to pay for it. Debt to equity is 0.44, also made worse by the increase of long-term debt. Interest coverage is just 6 times. More debt means more interest payments. Cisco seems to have reasonable short-term liquidity. The current ratio is 0.89, quick ratio is 0.6, and cash at 0.22. However, return on assets was just 6.1% and 16.5% was realized on return on equity, giving them an equity multiplier of 2.69. Next, the return on capital employed on a trailing 12-month basis is 16.7%. Return on invested capital, also on a 12-month trailing basis, was 19.4%. The effective tax rate of Cisco is 15%, giving us a NOPAT of 11.7 billion with an average debt to equity of 60 billion. Looking at the cash flows, operating cash flows were lower to $4 billion. Investing outflows were 22.8 billion, principally due to the Splunk acquisition. Financing inflows were 14 billion, primarily from issuing debt. Cisco finished the quarter with free cash flow of 10.4 billion. Cisco pays 40 cents in dividends, and they declared another 40 cents dividend for July. Yield of about 3.3%, growing at 2.6%, and a hefty payout ratio at 86%. More payout means less retained earnings for the company's growth. The enterprise value of Cisco is 210 billion. That's 4.1 times revenue, 6.3 times EBITDA, and 20 times free cash flow. The firm provided some guidance for the year and for the quarter. We're just going to give you the quarterly guide that they are expecting 13.4 to 13.6 billion with an earnings per share between 46 cents and 51 cents. We also used an EBIT average of the last 9 quarters. We took the midpoint of 48 cents, which gives us a forward PE of 25.2. Our key takeaways on the pro side is that Cisco still has good and improving gross margins. The dividend is attractive at a 3.3% yield. The Splunk acquisition will boost subscription revenue, growing the security and observability businesses. Cisco has good cash flow. On the con side, revenue has been a problem for the last 4 quarters. New debt issued by Cisco isn't excessive, but servicing it will increase interest payments. Cisco customer adoption has been slow implementing recent product offerings, and it's not clear when that will correct itself. That being said, we're giving Cisco a neutral rating. We think Cisco is fully valued at these prices. We have no exposure to this company. Like and subscribe.